Hi, it's Jacob Haddon here with Mortgage Consulting Group, a mortgage company built to educate the consumer. I look forward to all of your questions here in the comments below. Right now today I'm just answering some questions that come across my desk from time to time. Now, one big question is, for a jumbo mortgage, what's the difference between a jumbo at $1 million versus a conforming loan at about $500,000? Well, with your jumbo mortgage, you have additional risks. There's less liquidity for the lender, and that also causes the investor to look at adding more overlays to cover their bottom line and to have a little bit more scrutiny. So we do have to jump through a few more hoops for a loan that is bigger in size, but it's definitely worth it. Question number 2. Why do two borrowers with the same income get a different approval on a $1 million loan? For this, it's basically somebody who maybe is self-employed versus somebody who is W-2'd. Maybe they gross the same amount of income, but for a lender, we look at more of the net income if you're self-employed. When you have a W-2, we can use that full wage of the W-2, the gross, before taxes are taken out. And one of those things that causes that is the debt-to-income ratio. So we're looking at your debt-to-income ratio as well. Now, question number 3, how much cash should I really have left after closing on a $1 to $3 million purchase? On a $1 to $3 million purchase, you want to have about 12 months reserves in general, and plan on, if it's over $2 million, 2 appraisals. It is a good chance that that would happen. Now, depending on where your assets lie, it may be better to go with one lender versus another, and some do scrutinize and add more conditions than others. So I help clients navigate that process and pick the lender that's going to be right for that high net worth borrower. Now, question number 4, what mistakes kill jumbo loans or high balance loans in the process? And I would say it's generally if the rate is too high, too many points, or the process is just too difficult, or there's not enough value add for that borrower, and they decide just to pay cash. Question number 5, is it smarter to put 20% down, keep cash when buying in Colorado, or is it better to just put 3% down, or even a down payment assistance program? For Denver, Colorado, here where I'm based, I also do most 50 states in the US, but for here locally, the market has down payment assistance programs that can get you in with little to no money down, but those programs have an additional overlay on qualifying, and sometimes you have to go through a second set of eyes and underwriting to get approved for that. So you definitely want to look at all of your options. Oftentimes somebody will have a 401k and will borrow from the 401k to finance the purchase of the home, and that makes more sense than waiting an additional 15 days to close. So it just depends on the situation for the client at that time. And question number 6, why do self-employed borrowers get treated more conservatively on higher loan amounts? When you are self-employed and you are buying a bigger home, you are going to have a little bit more scrutiny. We use, the net income, and you have typical tax write-offs, but you also have add-backs like depreciation and other tax strategies that people take. Now, what I have is a non-QM product that allows for me to use just a CPA letter for a profit and loss and 3 months of bank statements to be able to qualify you if you show that income over 1 tax year. That's a really good product for a lot of my self-employed borrowers. Question number 7, what credit score actually matters on a larger loan that is in the jumbo category between, say, 800 and 3 million? Credit scores matter quite a bit. You definitely want to be over that 700 minimum credit score mark, and you want to have a good reserves, a good amount of liquidity, assets. Generally don't want to be a first-time home buyer, but I've done deals for people in that area that were first-time home buyers. And we want to make sure that the file is very clean going into underwriting, because the loan can just keep lingering on if we don't clear up all the conditions right off the bat. Question number 8 is, why do some lenders price high balance loans worse than jumbo and some don't? So for your high balance loans, you're generally in a category between your conforming maximum loan limit and your jumbo limit. And depending on the county, you may have different high balance loan limits, which allow somebody to get a lower interest rate generally if they're within that county that has that updated loan limit. With that said, a broker is the way to go because they can shop that deal with multiple lenders and find you the best rate at that high balance pricing. Question number 9 is, how early should I talk to a mortgage broker before buying a $1 million plus home? And generally you want to talk to your mortgage broker within about anywhere from 1 to 12 months. Anytime you think you might want to buy a home in the future, it's good to start having that conversation. And with that conversation, you want to look at, am I a small business owner? Do I plan to sell the business down the road? Is there something we can strategize and look at during the loan process to get ahead of that and to start planning that process right away? Question number 10, what does a strong borrower mean to an underwriter on a larger loan? Generally, a strong borrower for a larger jumbo size loan is going to be somebody who has a high net worth, who has good reserves in the bank to cover the mortgage payment if their monthly wage went away, and somebody with a 700 or better credit score, ideally 760 or better, as somebody who has a good track record of making their payments on time and has strong income, cash flow with their income. Stability is big. Job time, like if they've been at their job at least 2 years or over 5 years, those are really good strength additions to a borrower. Question number 11 is, can I buy a $750,000 home versus a $1.5 million home while keeping my current house as a rental? There is a specific scenario where that will work if the rental property is going to produce enough income to cover the mortgage payment. So if you're having to come up every month with that mortgage payment and the money that you're collecting for rent doesn't quite cover that payment, you're actually in a situation where you have an alligator property and you don't want that alligator to bite you. So we're definitely looking at that cash flow and being able to sustain that monthly cost on that rental property. Question number 12 is, why do appraisals become more of a problem once you go over that $1 million threshold? Several lenders in the past have said they wanted 2 appraisals anytime you go over $1 million. And now that's extended, actually it's doubled over my career from $1 million to now, if it's over $2 million, we require 2 appraisals on those jumbo products. So you no longer need 2 appraisals in most situations for a jumbo. Now different lenders have different guidelines on how many appraisals, so it does vary from lender to lender. And with those specific expectations, what I do is I set those at the application with the client in their specific area, what they're looking for. Question number 13 is, how do rate locks work differently on jumbo and high balance loans and conforming loans? So your conforming loans are, typically under the $700,000 or $800,000 number. Your high balance loans are typically right now in 2026 between $800,000 and $1 million. Million plus are your jumbo loans generally. Between these loans, there's not a difference on the number of days that you lock in a rate. So you can lock it in for 15 days, 30 days, or 45 days. And that protects you and you get that interest rate. So nothing changes through that time-sensitive transaction that you're in. Now question number 14, what's the difference between shopping rates and shopping structure on larger loans? When you're shopping structure on larger loans, you have to have a little bit of flexibility to adjust that rate, right? And so with more risk or more lenders that we're looking at, we're going to get kind of a mix of rates going up because of the difficulty of the loan and rates coming down because we're shopping the loan with multiple investors. So that's the answer there. Question 15, what should buyers in Colorado specifically know that out-of-state lenders miss? Well, in Colorado, we are a title state, so we're not going to attorneys to close on a deal. All of our offices are generally at the title company. Another big one is there's a lot of loan fraud. So a lot of times wiring instructions for sending money to the title company at closing go to the wrong location. And with the fraud that's happening, spoofed emails and all of these biggest transactions of somebody's life could have an impact where all that money goes poof that they just sent to the title company. We want to make sure that you're calling the title company to verify those wiring instructions. So you're sending your money to the right bank and the right title company for that closing. And so with a local lender, I can walk into a title company and I can say, talk to this borrower, here's the phone number, or I can call up, take these folks out to lunch and learn more about their business and make sure that we're a cohesive unit and working as one with the customer's interest in mind. These are some questions that I receive from time to time with customers that often come to me, referral partners that have questions about my business, and I would love to hear from you as well. So if you have a question, anything related to mortgages, I would love for you to post it in the comments down below. Definitely hit subscribe for future content, and I really appreciate you watching. Have a great day.